Hello, welcome back to WINFXTRADING YouTube channel, the channel that has been optimized to make you rich trading the Forex synthetic market. In today's video, I'm going to show you fourth, fifth dimensional analysis on Forex synthetic trading. Okay, this is a kind of something that looks strange, but this topic is going to change your life if you really watch this video to the end. Okay. The time frame mostly ranges from 1 minute to monthly, but there are some other charting platform where you can see seconds and up to years. Okay, other kind of dimensions like trading ranges and all of that. So here the 1 minute is first dimension, 5 minutes second dimension, 15 minutes third dimension, 30 minutes fourth dimension. Then the fifth dimension is either 1 hour or 4 hour time frame. Now I'm going to use the 4 hour time frame as the fifth dimension. So if you really want to make a reasonable profit, like on consistency basis, like consistently, then you should actually be running your analysis using the fourth and fifth dimension, meaning that you are standing on the fifth dimension, being the 4 hours, to actually determine the controller in the market and the overall direction of the market, and you are going to fourth dimension, which is the 30 minutes time frame, to actually get your entry. Even when you are not having the time and what it takes to go to the higher time frame, like other higher dimensions, you can use this fourth and fifth dimension and still be consistent. Okay, now I'm going to show you this practically when I get you back to MT5. Okay, this is a volatility 75-1S and the H4 time frame. You see, what people do is they just look on the 1 minute time frame, look on the other lower dimensional time frame like 5 minutes, 15 minutes, and just like that, they have started making their trading decision. It's not that they cannot go to other time frame, it's just a bad habit that they don't have this skill of art what we should do the top-down analysis. Okay, so because you can easily forget all of this top-down analysis, which has to do with going from the highest time frame to the lowest dimension, which is the fourth dimension, or even other much lower dimension like seconds or ticks. They just consider a kind of just one lower dimension. Maybe they will just look at 5 minutes, 1 minute, 15 minutes and make decision, which is wrong. What you need to do is, I'm going to show you. What you need to do is, you need to understand what is happening in the market at the 4 hour time frame first. Even if you are tired to do analysis, you have to do this 4 hour time frame. When you do that, when you know what market is doing in the 4 hour time frame, then you can follow that direction. With this idea, you can avoid a lot of losses due to error in top-down analysis. The error will come because most time you will not have time to do it, or you forget to do it, or you are totally tired. In the long run, you will have a lot of reason to lose more money. Okay, so that is it. I'm trying to make this thing realistic. An example should be, okay, this level has been broken. Okay, and we have a translational signal here. After the breakout, there is lack of equilibrium, or kind of, we have imbalance, or let's call it the market is under this equilibrium, which is what you really need to trade. You are not trading inside these structures because it's full of indecision. If you buy here, what if it sells? Or if you sell here, what if it buys? So it is in state of equilibrium inside this zone that I drew in the H4. Okay. Then when you are drawing zones, you are looking at turning points and you are looking at the highest wick as the height of the wick should be the width of the zone. Okay. So that's what I did here. So the translational signal, which is what you should trade, or this equilibrium or lack of equilibrium signal or markets that has set into this equilibrium. Okay. So entering somewhere here, you are safe. Okay. Like you are sure of what you are doing. Now, there are two types of signal: impact signals and width band signal, with the width broad signals. Okay, like a market that's actually set into this equilibrium and return back to the equilibrium zone. It is returning with certain width that is really broad compared to the impact signal that doesn't have a width. Okay, so if you miss the impact signal, you will not miss the broad width, but there are a lot of issues with the broad width signal or kind of width bound signal. One of the disadvantages of width bound signal is we find it hard to determine the valid stop loss, like the valid untriggerable stop loss, because most time price have to move and get a lot of liquidity sweep and take you out. Okay, so that's good. So when you know that the overall direction of the market is downwards because of what you see that happened here, actually this dimensional stuff based on break of structures, yes, if market is able to break the structure like with these horizontal levels, zones, the direction of the breakout is the direction of that market at higher time frame perspectives. Okay, so right now we go to 30 minutes time frame, which should be the entry. Now, as a wise trader, you're actually going to apply the same idea of breakout. You are looking for breakout to the downside, where a turning point has been broken to the downside and being violated. Okay, so, and not just a turning point, but trend line must also be broken, and the moving average direction must actually change, like the tangents to the 200 moving average should be negative, because we are looking for downward signs. So you keep measuring this 2-point trend line, keep measuring, waiting for price to break it. If when it was here, it's failing to break it. It's failing to break it. If it break it, it should not be a kind of fake breakout. You should get a valid breakout, a breakout whose length is at least equal to the source break, equals to the reflection, a kind of front wave, like the reflection, like price event that lead to that break. An example is this is a bearish retracement of 313 pips. So we actually looking for a break of this length, but what we see here is less. Okay, is less. At least when you want to start engaging on the signal, the signals should be modeled with a straight line. So if you are trying to model this breakout with a straight line, you see that one of the parts of the straight line will be outside the signal zone, like outside the signal. Like get a parallel line parallel to this, the first one, and then attached to a turning point. You notice that part of this, we know the direction of this plane is negative, showing sell, but part of this channel is within the positive plane. It has violated the signal. The signal is not accurate. We really need certain pre-signal, like certain we need certain signal movement, like price movement, that we obey fundamental technical tools like trend line, moving average, moving average reactions, yeah, moving average reactions, at least a break of a point, yeah, like when the market have left the previous signal zone or region to a new signal zone or region. In that new signal zone or region, you should break at least one single point. So price breaking this point here is a sign of strength. Okay. And the other thing is price doing certain things, to confirm your signal, like to validate your signal, is not a guarantee that you just it's not a guarantee that you are safe to enter the market at any price. What I'm saying here is price break this turning point shouldn't give you the reason to enter the sell here. No, you should wait for where people sold. So that should be a technical tool that models where people are selling, basically a trend line or a kind of resistance or support zones like this one. So waiting for price to keep breaking this point, taking this point, and waiting for price to react to this upper trend line or here, any of them, is a great entry zone. At least you will avoid the counter signal that should come due to error in entry. If you enter here, it will start retracing, and then you will panic. Basically, if your stop loss is not wide, you will be taken out, and in the long run, you will miss a lot of signals, because depending on who you are, you will be missing a lot of signals because you don't want to re-enter after your stop loss is hit, unless you are strong enough to take losses, which is what most traders find it hard to do. And what they do is they just miss that signal and they revenge on a wrong signal and lose all their money, and it's going to repeat over and over and over. And actually, a lot of things we need to make this realistic, because I was like, no modulation of moving averages, so we get to moving average and modulate. There are a lot of human errors while doing signal synthesis. So we go back to 75YS, so that the moving average loops we have to validate where we're heading to. So this is the 30 minutes time frame. So based on the observation point, we are somewhere here to get our trend line, and then we have this break here. So when we have this break here, this break result from this input. Okay, result from this input. The input to the trend line actually created this channel. But why this channel is invalid is that the size of the breakout that actually lead us to throughout this channel, the size of the breakout is not equal to the source. It's not even up to half of the source. At least it should be equal, or half of the source should be equal to the half of the source. Here we have over 300, or equal to the source, or be like either greater than the source or equal to the half. Okay, now because it's not obeying that rule, we still have another judgment here, that there is no break of structure inside the new signal zone. At least one break of structure. There should be one break of structure in the channel. When you don't wait for this confirmation, you rush the trade and you lose more money. Yes, because look at what happened here. We're expecting it to rebound back and take out this point to actually increase our odds. There's no need of entering market too early and losing more money. It's better to enter here because you are sure right now it's going in your favor, right? And then get a valid stop loss placement, and that is it. Once you get a valid stop loss placement, you can hold that trade for long, because you believe there's no way price will go and trigger the valid stop loss. Okay, So because this there is no rejection, there is no reflection from here to take out here, there is no way you will succeed in this type of stuff. An input to a plane or signal plane, which is the negative signal plane as you're seeing it, is the input to the negative plane. Okay, the input creates an output to a positive plane. So how do you feel in this kind of stuff? This is an input here, then the output is this over 843 pips, meaning that no matter how you try to position to sell, you lose more money. Even though the H4 is selling, it is not selling them without a time frame. Okay, so the point I'm trying to bring here is about the moving average, because I haven't said that the moving average modulation analysis is very important. Yes, price is trading below the moving average. Look, which I'm using here, 200, 150 moving average. See, it's trading below it, but because it's trading below it is not a guarantee the signal is going to move. It's trading below it is one of the signs that it's changing direction, yes, because this indicator is lagging, so you can use it as a valid confirmation too. Then the actual thing to actually succeed here is the turning point violations. Like at least one break of structure is needed. It's not outside the signal plane, but it should be inside that signal plane. There is no point of rushing a signal plane because you just see an like signal flowing inside the plane. No, there is no need of it, because if you do that, this kind of stuff will happen to you, and it will happen to you in a painless manner. In the long run, it will become painful because you lose more. Are you getting me? So always actually use valid price action analysis. This is cool. Indicator might help you to believe certain things, but they will still fail you, because once price change, they will just switch over and modulate the new price. They just follow the price. They don't predict a new price. They just follow price and they lag behind it. So the question now is, then when will it start selling? I'm going to draw it for you. I'm going to use the indicator chart and make it more realistic. Now, one of the ways to know that this market have started selling is, the first thing is, it will stop making higher high. This is the last high, right? It will fail to take out this last high, and then it will create a sell plan that will violate the current buy plan. You know, the buying plan is like this. Okay, so we need a kind of reflection over this plan. We need a plan that will intersect with this plan at certain angle with certain plane width, and then we need the signal to flow inside this new plane, which is a negative plane. I'm not going to be dealing with the polarity of the plane, because I have one plane analysis. I will drop the video link to the plane analysis so that you understand what I mean by plane. So we need at least one break of structure, which will happen here. So we have one break of structure here. I get inside the new plane. It's not, you will be finding it painful for this thing to happen, but you have to wait. That's where we know who is waiting and that patience. And so the only way you can now enter is to use extreme conditions. Okay, now the extreme condition, you're gonna wait for price to enter the middle of the plane. You enter, your stop loss will always be outside it, like outside the plane, but then about a turning point, maybe outside the plane, and then somewhere here. Okay, and so now you can enter at the middle, or you wait for price to come to the extreme boundaries like here, so that when it goes to the boundaries, then your stop loss limit is minimized, or in the middle is a little bit higher, but then you will make it because this is a sure plan, sure signal. That's good. You see, watching video is not the only key to succeeding in trading. You need someone to make you successful. And one of the ways, I keep repeating this, you have to be in our VIP signals, groups and channels. If you don't want to make it here, if you want to prove yourself strong, then you can go ahead and be on your own. But the proverb here is that for you to succeed at speed of light, you leverage the effort of others. I'll give you an instance. There is no way one company will succeed on its own. There is no way an individual will live on his own without depending on the services of other individuals. I will give you an instance. You see, a Forex broker cannot succeed on his own without the help of a website developer, without the help of software developer, the application developers, like the developers of the MT5 and other trading tools. No, you are there as a broker, is a manager of the traders and what they are doing in both deposit and withdrawals and the activities, but they can provide all the tools. Are you getting it? So if they are now trying to provide all the tools by themselves, they will fail woefully. They will fail from time to time. They can never establish anything. Are you getting me? So right now, I urge you to rethink over and over, and you are like a newborn baby. You have to depend on people to growing before you fly. Are you getting me? No matter how you try, you must bow. Are you getting me? Because you don't know what we are doing here. We are in the background sacrificing a lot of things to make you succeed. So bye.